Looking for income from your investments without picking individual stocks? UK Dividend ETFs are one of the simplest ways to do it, especially if you're based in the UK and want exposure to familiar companies. Dividend paying shares get a lot of attention because everyone loves the idea of passive income. And for UK investors, UK focused dividend ETFs offer a straightforward route to access a basket of established income paying companies without the hassle of researching or managing a portfolio yourself. But with so many UK dividend ETFs on the market, each with different strategies, sector weightings, and filters, how do you choose the right one? In this video, I'll break down what exactly a UK dividend ETF is, the key terminology needed to research them, and the key differences between some of the options available, so you can understand what you're buying and why it might or might not be right for you. To be clear, this video won't tell you whether you should invest in dividend ETFs. That's for you to decide based on your own goals and research. I'm just here to give you some information so you can make those decisions more confidently. So, what exactly is a UK dividend ETF, and why might you be interested in one specifically? A UK dividend ETF is a type of fund that invests in a portfolio of UK listed companies that pay dividends. It could be any distributing ETF that contains UK stocks, or it could be one that applies specific filters to focus on dividend paying companies, like high yields, consistent dividend growth, or broader quality metrics. As for why UK dividend ETF specifically, first, there's the home bias element. UK listed companies tend to be more familiar, and some investors feel more comfortable knowing the businesses they're investing in. Second, there's usually no withholding tax on dividends from UK companies, unlike US stocks, which the ETFs, often domiciled in Ireland, have to pay a 15% withholding tax on the dividends from them. And finally, UK dividend ETFs generally offer higher yields than their US-focused counterparts, making them appealing for income-seeking investors, especially in uncertain markets. That said, these funds often lean heavily into large-cap UK companies, especially from sectors like energy, finance, consumer staples, and utilities. That means your exposure may be more concentrated than you think, which is worth considering when building a balanced portfolio. So let's dive into some key terminology. First up, distributing versus accumulating. A distributing ETF pays out dividends to your investment account. An accumulating ETF reinvests the dividends at fund level, which can help grow your investment over time. You would think when talking about dividend ETFs, we only want distributing ETFs. And that is true. For most people who want dividend ETFs, you're going to want a distributing ETF that actually provides dividends. However, if you're investing into dividend ETFs for another reason or a certain strategy because you feel like that style of investing will do well in current market conditions, you may actually prefer an accumulating version of a dividend ETF. It's not always straightforward. Next up, dividend yield. This shows how much income the ETF has paid out annually as a percentage of the current share price. Higher yields may seem attractive, but may also signal risk, so always take a further look. Don't get drawn into higher yields. Next up, index benchmark. Each ETF tracks a specific index, like the FTSE 100 for example. Make sure you understand the methodology behind the index, how it selects stocks, how often it rebalances, and whether there are any additional filters you need to be aware of. Total expense ratio. This is the annual cost of owning the ETF. While costs for ETFs are typically low, they can vary quite a bit and some charge significantly more than others. So keep that in mind as fees can eat into your returns over time. Fund size and liquidity. Larger funds tend to have better liquidity and tighter bid-offer spreads. This reduces trading costs and makes it easier to buy and sell. This is something that is not always mentioned, but it's always worth checking fund size, liquidity, and consequently bid-offer spread. And speaking of bid-offer spread, this is the difference between the price you can buy and sell an ETF for. A tight spread is usually better as you're losing less on transactions, and tighter spreads are usually found in larger, more frequently traded ETFs. Sector and stock breakdown. This just refers to the composition of the ETF, what is actually inside of it. It's worth checking this because some UK dividend ETFs can be highly concentrated in a few sectors like oil, banks, or tobacco. It's worth reviewing what you're really holding. Okay, now let's look at some of the most popular UK dividend ETFs. For each one, I'll break down the key information so you can understand how they differ. A quick disclaimer before we dive in, the ETFs I'm about to cover are not recommendations. Instead, they're a selection of some of the most popular and/or interesting UK dividend ETFs currently available on the market. The goal here is to walk you through the key details to help kickstart your own research and show you how to evaluate any ETF using the same framework. As always, make sure to look into the latest fact sheets, index methodologies, and your broker's offering before making any investment decisions. It's also worth noting that all of the ETFs that I'm about to discuss use physical full replication, meaning they directly hold all the stocks in the index they track. This is likely due to the relatively small number of holdings in each index. First up, and probably most familiar, we have the iShares Core FTSE 100 ETF. This has the ticker ISF for the distributing version and CUKX for the accumulating version. The index it tracks is the FTSE 100. The total expense ratio is 0.07%. The fund size is £11.7 billion for ISF and £2.3 billion for CUKX. And the dividend yield is 3.48%. This ETF is simply a tracker of the 100 largest companies listed on the London Stock Exchange. Despite it containing 100 stocks, it is heavily concentrated. The top 10 holdings make up around 46% of the ETF. Sector-wise, it's very defensive, with heavy exposure to energy, consumer staples, and financials. That concentration has worked out in its favour so far in 2025, with defensive stocks holding up relatively well amid uncertainty. Up next, we have the Vanguard FTSE 250, ticker VMID or VMID for distributing, and VMIG, VMIG for accumulating. The index it tracks is the FTSE 250. The total expense ratio is 0.1%, and the fund size is £1.55 billion for VMID and £584 million for VMIG. The dividend yield is 3.43%, so pretty much the same as the FTSE 100. This ETF tracks companies ranked 101 to 350 by size on the LSE, making it more focused on mid-caps. The FTSE 250 is more representative of the UK economy since these companies earn more revenue domestically. It's much less concentrated than the FTSE 100. The top 10 only make up about 11% of the ETF, but it has been a weaker performer in recent years and tends to be more sensitive to inflation data. Turning now to the iShares UK Dividend ETF, ticker IUKD for the distributing version, and as far as I'm aware, there is no accumulating version. The index it tracks is the FTSE UK Dividend Plus Index. The total expense ratio is 0.4%. The fund size is £907 million. And the dividend yield is a pretty bumper 5.19%. This one selects 50 of the highest yielding stocks from the FTSE 350 universe, excluding investment trust, and weights them by forecast dividend yield, not by market cap. I like that the focus is on forward yield, but I'm not convinced that weighting solely on yield is wise. It leads to exposure to defensives and banks. Financials make up about 32% of the fund. Longer term returns for this fund are relatively poor, and the TER, total expense ratio, of 0.4% is one of the highest in this category, which, in my cynical opinion, is fund managers capitalizing on demand for high-yielding products. We're now going to look at a couple quality-filtered dividend ETFs. They're a little different. They apply quality filters, typically screening for companies with strong balance sheets, consistent earnings, and stable or growing dividends. The idea here is to avoid yield traps and focus on sustainable dividend payers that may have room for growth too. The first in this category is the L&G Quality Equity Dividends ESG Exclusion UK ETF, ticker LDUK, distributing only. The index it tracks is a bit of a mouthful. It's the FTSE All Share XIT XCW XTC XREITs Dividend Growth with Quality Net Tax Index. So FTSE All Share with a quality filter and excluding a few category of companies. The total expense ratio is 0.25%. Fund size, £47 million. Dividend yield, 4.14%. And to summarise this ETF, it selects UK companies with positive dividend growth, relatively high forward yields, and enhanced quality exposure. In theory, I like the quality focus, and performance over the past year has been solid. However, looking further into it, financials dominate, making up nearly 55% of the fund. There are only 37 stocks in total, and the top 10 make up a massive 57%. So it really is highly concentrated. Still, it's interesting to see Games Workshop topping the list. And then the other quality ETF we have is the Wisdom Tree UK Quality Dividend Growth, ticker UGRW, and this again is distributing only. The index it tracks is one designed by Wisdom Tree specifically, the Wisdom Tree UK Quality Dividend Growth Index. The total expense ratio is 0.29%, and the fund size is a very, very small £9 million. The dividend yield is 3.24%, so pretty similar to the FTSE 100. This ETF is relatively new, and I was genuinely excited about this ETF when it launched. On paper, it looked promising. using a composite quality momentum score to screen UK companies, then weighted by total dividends paid. It also applies ESG screens and liquidity requirements. But something has clearly gone wrong. According to WisdomTree's own data, the tracking error, the difference between the ETF's performance and its benchmark, is awful. Whether it's due to the merger with WisdomTree UK Equity Income or something else, the execution has been very poor. If there's something I'm missing here and there's a clear reason for why the tracking error is so bad, I'd love to know, so if you can, let me know in the comments below. I'd love to hear. We can also add to that the fact that quality-tilted stocks have not done too well recently, especially as defensive, value-oriented shares have outperformed due to macro themes like tariff risks and uncertainty. So it's not been a great time for UGRW, but over the longer term, if it doesn't always have such an awful tracking error, and if we tilt to a scenario where quality does well, then this ETF may well be a good long-term performer. It's hard to know. I still think the methodology is interesting and worth watching over the long term, but to be clear, performance so far has been disappointing. So, which one should you invest in? Well, the answer might be none at all, I don't know. As always, the right choice comes down to your investment goals, preferences, and risk tolerance. But here are a few things to think about for dividend ETF specifically. Back to distributing versus accumulating. As I say, it may feel odd to buy a dividend ETF in accumulating form, but it really depends on your goals. If your reason for investing in dividend-paying stocks is due to a belief they'll perform well in a total return sense rather than wanting income, then accumulating may make perfect sense. Not every dividend ETF investor is using it to generate cash flow. If you're in the accumulation phase of your investing journey, it might actually be preferable to go for the one that reinvests automatically. Dividend yield versus quality. You have to weigh these two up. High dividend yield doesn't always equal quality. Many high-yielding companies are defensive, low-growth, low-PE businesses, like utilities or tobacco stocks. Meanwhile, companies with lower but still attractive yields may have better growth prospects and stronger balance sheets. That could result in better long-term total returns, even if the income isn't as high today. But then again, defensive, value, high-yield shares can do well in certain scenarios. And this links into the next point. Consider the index methodology. Some dividend ETFs simply screen for the highest yields with no regard for quality or sustainability. That might lead to poor diversification or exposure to troubled businesses. In this space, having a smart filter like excluding companies with negative earnings or inconsistent payouts may be a real benefit. Always look further than just the fund name. And finally, fees, liquidity, and spreads. Watch out for smaller, newer funds with poor liquidity or wide bid-offer spreads, especially if you plan to invest large amounts. Also, remember that in general, a lower total expense ratio is a good sign, but not if it comes with a poor tracking error or doesn't meet your requirements in other regards. Whatever you decide, the most important thing is knowing what you're buying and why. So that was an overview of UK dividend ETFs. Hopefully this helped break down things a bit more clearly and gives you a good base to go and explore these funds further. If you found this helpful, be sure to like and subscribe. It really helps the channel and lets me know you want more videos like this. Thanks for watching, and I'll see you in the next one.